Hello, and thank you for joining us for the State of the Markets presentation from Stark Financial Strategies. Today we're going to run through a look at back at 2020 and then some forecasts out into 2021. So as we get started into that, I will first cover our disclosures for this presentation. It just says that past performance does not indicate future results, that we're trying to do our best job of current market conditions and economic numbers to give you an idea about what to expect in the future. But of course, the markets do fluctuate, and you should always consider your personal risk tolerance when making any investment decision. But really, the main agenda we have for today is going to be how did stocks perform in 2020? What drove that performance? Where are we right now? And then what are we going to forecast for 2021? So we did think about changing the name of this slide to Hindsight 2020, which would be our last opportunity to use that joke. Yeah, we're going to be looking back really and trying to get an idea about what really happened this past crazy year. At the beginning of the year, we had these particular investment companies were making predictions on where they thought that the S&P 500 stock market index was going to be by the end of 2020. And just to give you a frame of reference on that, we had started with a level of 3234 on the S&P 500 index at the beginning of the year. And the predictions were being made that were everywhere from Morgan Stanley saying that they thought that we might only see an S&P 500 of 3,000 by the end of the year. In other words, a negative year. And then up to Credit Suisse with a 3425, and then with a consensus average end up being 3272. So really barely any growth in 2020 was the prediction. And instead, we ended up at a level of 3756, about a 16% gain in the S&P 500. Obviously very surprising considering the volatile nature of what happened in the market, but that just shows you the power of the government flooding our economic system with money and how that helped out the stock market. Although it wasn't all roses in the market. This chart shows you where things were at the end of September, and I had shown this chart to people back in October about how by the end of September the S&P 500 index was sitting right around 6%, and then the top 5 technology companies had a performance of almost 40%. And that's Microsoft, Google, Amazon, Facebook, Apple. And so those, if you consider those top 5 at a performance of about 40%, that means the remaining 495 companies that make up that index of 500 had a collective negative 0.5% by that point, with the biggest losers being the high dividend stocks, which included a lot of the big classic American companies that usually people go to for protection in a down economy. Actually was not the place to be, but instead you should have been all in big tech. It was a completely different kind of recession and stock market pullback than we've ever experienced before. So we'll take a look at some of the things that really drove that market performance. In particular, here's a color-coded chart that shows some of the different things that occurred over the course of the year. And you can see how the blue-coded things are related to COVID-19 really were the main market movers last year. Obviously, you just couldn't get away from it. That's had the biggest influence on what happened. We'll look in particular, though, at some of the other things like the federal funds rate. And this shows where the interest rate that the Federal Reserve charges was down here in 2016. It had been down here pretty much since 2008, the beginning of the financial crisis, and they started to raise the interest rates in 2017, 18. And then by the time we got into 2019, the Federal Reserve realized, oops, we made a little bit of a mistake. We were going a little too fast on raising the interest rates. So they did a couple cuts, and then COVID happened, and they took rates basically down to zero. A few of the things that they were performing during that time period is, this is a partial list of the things that were going on the first half of the year. And you can see a lot of these things were things that either they had tried to do back in 2008 and 9, or it's things that economists talked about as a result of 2008 and 9, looking back and saying, boy, if we could have done things a little bit differently, we might have gotten out of that crisis a little bit better. And so a lot of these ideas on things they implemented might not have happened if it hadn't been for that 2008-9 experiment and what the Federal Reserve could really do and where it fell short back then. This shows one of the problems we have in trying to predict where the stock market is going to go, and it shows corporate earnings growth dating back into 2018. So here over on the left-hand side, we have quarters 1, 2, 3, and 4 for 2018. You can see this great corporate profit growth during that time, and then it leveled off during 2019, and we had negative corporate earnings in 2020. And then 2021, again, they're predicting some pretty high positive growth. So it's kind of telling that back in 2018, if you remember, we actually had negative stock market performance in 2018. And that was when corporate earnings were fantastic as a result of the 2017 tax cuts. And then the stock market was fantastic in 2019, over a 30% return in a year when corporate earnings growth had leveled. And then we get a positive return when earnings are negative. So just because it shows positive earnings over here for 2021, we probably shouldn't get too excited about that. A lot of times the stock market is a leading indicator as opposed to looking to the past or present indicator. So let's kind of take a look at where we are right now. In order to do that, actually, we're first going to go to the past. So this is our economic speedometers that we like to look at. And it goes back to December 2010. We're going to take a look at that. That particular economic item is green if it's positive for the economy, yellow if it's neutral, and red if it's negative. So you can see back then, out of 20 indicators in 2010, we had 16 of them positive, 2 neutral, 2 red. So back then it was screaming, great news for the economy, great news for the stock market, just, everything looked good. And yet, if you remember what it was like back in 2010, people were still really negative. People were not feeling it for the economy and the stock market, and were still very hesitant and cautious, and they weren't really willing to dive in back then. So if we flash forward here to January 2020, a decade later, going into this year, we had kind of a mixed bag with about half positive, half neutral, and then 2 reds items, one of which was geopolitical risk, which I dealt with the trade tensions we have with China and the different tariff wars. And then, of course, the political environment was a negative just because we were going into a presidential election year with a very polarizing president. So a lot of those flashed red throughout most of the year and then had started to recover. And here by November 2020, we rode down the stock market and back up, and the economy's starting to get reopened, by November. And we're looking again at about a, half green, half yellow, positive and neutral, and then 4 reds. With an addition to the political items, we had disposable personal income, meaning the American consumer kind of felt like their pocketbook might start to be getting a little squeezed, and equity market valuation was a red, and that basically meant that stocks were overvalued at that time, had been overbought. So that was just prior to the election, and so we'll go then to the January chart that we had just gotten in here recently, and it shows a couple changes there. In particular, the disposable income moved up solidly into the neutral territory, and a lot of that had to do with the additional relief passed by Congress, people having more money in their pockets, and the prospect of more with another bill possibly getting approved here soon. And then equity market valuation actually did move up from the negative just barely into the neutral territory, which is a good sign. And of course, our 2 reds will probably be with us for quite some time dealing with politics. So overall, the outlook on the economy looks pretty good. This chart shows the leading economic indicators that we look at, and it's a mixed bag of different things that the Federal Reserve produces and other organizations. There's 10 different indicators that make up this overall index. And you can see how going into 2020, just about how positive everything was, as leading indicators were at a level we just had never seen before. I really felt like going into the beginning of 2020 that we were just poised for just an unbelievable economic growth that year. It just looked like there were so many positive signs going. It could have just been just an unreal positive year for the American economy. And instead, we got COVID. So the economic indicators have plummeted and then rebounded. You can see the little breakout chart down here. So in the last 12 months, those numbers are starting to get back to, close to where we were in January 2020. So, the hope is that, we're going to get there. And that's a good indication of about we wouldn't have gotten through this COVID mess with our economy unless we had been that well situated prior to that. This unprecedented economic growth of the previous few years had both individuals and businesses in great financial shape as we went into this. Some of the headwinds we're going to be facing in getting the economy really rolling again is dealing with the vaccine distribution. Interest rates are starting to climb a little bit. A lot of international actors have a tendency to try to test a new president. So we'll see, recently we had China flying airplanes into Taiwan airspace, and some coup going on in Myanmar. So we'll see how all that plays out. The one that most concerns me, though, is this one with the economic scarring. For people that were working from home and still getting paychecks last year, they don't really, it's one thing to intellectually say, oh, I know restaurant owners had a hard time last year. It doesn't fully explain about what self-employed people and restaurant owners and that class that basically had their livelihoods taken away from them. It's just devastating. It's difficult to fully explain in words about how bad that was for those people. So how negative are they going to be feeling? Did we destroy our entrepreneurial class in America? How willing are they to go out and try again to rebuild? It's that's an unknown. That's a little scary. Some of the tailwinds we have behind us that I'm pretty confident about are going to be of course, the vaccine gets out. We're already seeing that new case rates are plummeting. Fed still has easy money. Corporate profits look good. The American consumer is healthy. A lot of good things going on. I had mentioned about about how the American consumer is looking good, and this chart shows a general indication of that. That you can see how the savings rate of the average American skyrocketed in 2020. All of a sudden, people are sitting at home. They're not going out to eat as much. They're not going on vacations. Everyone had a lot more money, and they've been saving it. That bodes well for if we were to get some sort of a stock market pullback. There's a lot of money there that may go into the economy. There were records set amongst the independent brokerages like TD Ameritrade, E-Trade, Schwab, and the number of new investment accounts opened in the first half of the year. Just unbelievable amount. And a lot of that individual investor opening small investment accounts and putting money into the stock market when it was at a low was a big part of the rebound that we got. So that bodes well for both the economy and the stock market, that as that money starts to get used and people are allowed to go on vacation again, it could really grow pretty fast. The other side is on corporate America, that when COVID lockdowns first started happening and they immediately went into defensive measures, they were trying to save money as quick as possible. Obviously, they were laying people off. They stopped doing stock buybacks. They started to stockpile cash. And now that things are looking a lot better, there's a good chance that extra money is going to possibly be going into stock buybacks, which would really help prop up the stock market again. If we had a little bit of a downturn, a lot of that money would flood back in. So there's a lot of positive things out there that I think we're going to see. And this shows a chart of looking at the S&P 500 index price to earnings ratio. And it's one way to measure the valuation of a stock. And it's just like the name says, it's taking the price of a stock, dividing it by its earnings, and you get a ratio of which the average is around a 16. So back in the tech bubble years, we ended up getting a number that got into the 20s. And of course, we remember how that happened, turned out with the market plummeting. And then post-financial crisis 2008, we had PE ratios down here around the 13 level. I mentioned about back in 2010 that the indicators were screaming buy, 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 but people are still really negative. And then when the economy really did start to take off, we climbed all the way up. We're really sitting at kind of a high level on the PE ratios going into January. And there's a little bit of concern it might have been overvalued back then. And then it plummeted with COVID and then had just an even bigger rebound. So our PE ratio actually is really high right now historically. It's in the 21 range. That's very high. It is a little bit of a concern, but that's not the only way to measure the value of a stock anymore. I've been showing this doing this chart to a lot of people lately that has the showing the difference between the way corporations do their accounting when they spend things on tangible versus intangible investment. So a tangible investment, example of that might be, say, Coca-Cola decides to build a bottling factory. They're going to put money into that. You're going to build a factory. You're going to have a hard asset you can actually look at and see. That's a tangible investment. And so the way they account for that, rather than taking a $100 million hit on their corporate earnings report on the year in which they have built that, they instead spread that 100 million out over like 10 years, take $10 million a year as a sort of a depreciation, I guess you could call it. And so that way investors don't look at their stock and go, oh my goodness, they will have this huge loss in one year and then they had a big profit the next. It evens things out and it's easier to value the true value of a corporation doing that. Well, more modern corporations, they're not building factories anymore. Instead, they're doing the intangibles and they're actually putting a lot of their money, like developing a new software means they're spending money on salaries of programmers. And that is a hit to the bottom line of a corporation the year in which it happens. So conclusion on all that is that if you valued the stock market solely off of a price to earnings ratio, you could easily make the argument that it's about 48% overvalued. If you value the market off of price to free cash flow, when you take more into account the intangibles, you'd have to say that possibly the stock market is about 12% undervalued. So, the truth is probably somewhere in between. My guess is you could say that the stock market's overvalued by, anywhere from 10 to 20% right now. So our forecast based off of that, we'll take a look at what's going on for 2021. In particular, we're going to look at the inflation rate, which had been hovering in this about 1.5, sub 2% range around there, even though over the last 12 months, we have had an increase in cost of food. And a lot of that does have to do with, people weren't eating out. So they're going to the grocery store, and it just got more expensive for the grocery stores to do the kind of cleaning and hiring additional people to keep everyone safe so they could continue to shop there. So that was up at the same time that energy plummeted because nobody was driving their cars. So huge savings there. And we end up coming out of that average inflation rate. Kind of one of the concerns is that you might get energy would start to climb and go from being a negative to being a positive. And if the food expense doesn't come back down, we could see inflation then start to creep over 2%. And then once it gets over kind of that 2.5 mark, it's kind of where we get in a little bit of a danger zone with our economy. This is a chart I always like to show people. I think it's kind of a fun thing to see, and I'm looking forward to seeing how it develops here over the next 5 years or so. That this chart shows in the pink, it's the unemployment rate, and the blue is wage growth. So the way to look at that is that during a rising economy, the unemployment rate comes down, and eventually it gets to the point where in order to entice workers to come work for a corporation, to get them off the unemployment or to move from one corporation to another, they have to start paying more money. So this is wage growth comes up. Eventually they're paying people too much money and they start to say, oh, our costs are so high. They start to lay people off. We go into a recession, unemployment goes up. And then of course they start hiring again. Eventually they start causing wage inflation. So you can see how every time they kind of come near each other, then they bounce away. And I was thinking as we got into 2020, we'd already had touched in 2019, and I was thinking we might muddle along for say about 3 years, kind of close to each other before that separation of unemployment and drop in wage growth. And instead we got COVID. So there's this giant spike in unemployment, but at the same time, it's kind of odd that there's also a spike in wages. That shouldn't happen. Normally, when there's unemployment going up, wage growth should go down. The reason for that odd chart is because most of the people who lost their jobs were lower income workers. Hospitality, leisure, food, hourly workers lost their jobs and salaried technology workers kept theirs. So the average wage went up actually at the same time as unemployment. So we'll see how this all shakes out as the numbers come in and we can kind of digest them a little bit better here over the next couple of years. But I do think it's good that we can still see a gap between wage growth and unemployment. That indicates that, that's kind of good. That's during an expansionary time period for the economy to have that gap. So hopefully that'll continue to do well. The new predictions on where the stock market is going to go, with a low target of about 3,900 all the way up to Goldman Sachs saying 4,300, and then the consensus landing here at 4,117. And that would indicate, the average analysts were thinking of like about an 8% return this year on the S&P 500 index. But like we talked about back on the corporate earnings numbers, that may be a not as solid of a prediction as you might think. Remain to see. After being up so far in 2020 in the midst of just horrible earnings and economic destruction, I'm not as convinced that we're going to have a big year this year. And one of the reasons for that is another method of measuring stock market valuations. This is called the cyclically adjusted price to earnings ratio, or CAPE. And just where that number is right now, it lands here, and it would indicate when you go off to the side is that the average annual return of the stock of the S&P 500 index would be estimated to be only about 4% average annual return over the next 10 years based off of the current level of valuation we're at. So don't be surprised at that. I'm still watching. The CAPE ratio is relatively new. It's been relatively accurate. So I don't necessarily believe in it completely, but it is an interesting indicator to keep an eye on. Looking forward, a couple of the other things we're going to keep an eye on is going to be that the equity risk premium, as they call it, is one reason why stocks could still probably be called inexpensive in some areas. Anytime that you invest in the stock market versus like the safety of the treasury bond market, you have to be compensated for the extra risk that you have. And right now with Federal Reserve interest rates at basically zero, you have to have that compensation for the risk, and stocks really are paying fairly good dividends right now. The dividend payers, they look like a pretty good deal right now, that they would lean towards the cheaper side. The other thing we have going on is a change because the Federal Reserve keeps, the federal government, our politicians are spending money like drunken sailors. It reduces the financial stability of our economic system, especially the government debt that's there. The value of the dollar has been dropping. The dollar index has been going down. And so what that would indicate is that it might be time to look more closely at investing in non-United States stocks. Most of from talking to me is that I did make a change with that several years ago and get away from investing as much in international. I've been trimming positions out of it for years. The result of looking back a few years ago, I was looking at the chart and showing that the average annual return to the S&P 500 index was 8%, whereas the international index was 2%. I thought, why should I keep investing any money in international with such low potential returns? Now I'm having to reevaluate that position and really look strongly outside the United States to wonder if that might be the place to go. Last chart here just shows that there's the blue bars show the return of the S&P 500 index in different years, and then the orange dots indicate what the intra-year low was during any one year. So like this one shows that in 2008, the stock market had a negative 38% return, but at one point was down 49%. You really didn't want to have sold at 49%. You would have missed out. Same thing too with this year. People that sold at the bottom that were completely freaked out over where the stock market was going, was down 34%, missed out on having a pretty good year. So it's good to, be ready to stick with a strategy and stay with it. So some of the things we always ask people to do for us is that if you do have anything that changes in your life, kind of keep us informed. It does help us to monitor your investments and know if there's something coming up that would affect your need for, say, withdrawal out of your account. Knowing ahead of time is just better for us to plan for it. Let us know if you have any concerns about the investments. When you look at your statements, you think, I really don't understand what's going on with this. Just pick up the phone, send us an email. We'd be glad to explain anything you have a question about. And the third thing is just to make sure your important legal and financial documents are up to date. This past year, I did have 4 clients who passed away. Usually I would see, one every few years. So none passed away of COVID, but it still was a rough year working with loved ones and handling their assets and disposition. I will tell you that they all had their documents in line and things went pretty well and still are going well. But in the past, I have worked with families that did not have their paperwork in order, and it just makes things very difficult to deal with. I strongly urge you to make sure that your will, power of attorney, medical directives, the beneficiaries on your investment accounts, that everything has a look at, just to make sure that you have it right. And of course, what we're going to continue to do for you is keep you informed through regular communication. We'll be doing these webinars on a quarterly basis for the economic updates, and some of the off months we'll do some special things on some different different things with the economy and financial planning to kind of help you understand what's going on with your own financial plan. And we're constantly staying on top of all the changes in the market. I told people this past year by beginning of May, I felt like I had digested about 2 years worth of financial data over the previous 2 months. And it was just overwhelming how much we had to keep track of. I'm hoping this year is going to be a little bit easier in that regard. But so that's the basics of what we had for our update. I hope you found it informative. Anything that you do have a question about, absolutely just let us know. We'd be glad to give any updates on this webinar, or if you do have a particular question about another item with your own personal situation, just absolutely get in contact with us. So again, thank you very much for joining us, and I hope you guys have a wonderful 2021.